Good evening, everyone, and welcome. It's billed as a kind of summer camp for monetary policy superstars. The annual retreat for central bankers hosted by the Kansas City Federal Reserve in Jackson Hole, Wyoming. And today, amidst the elk, the moose, and the low-hanging clouds, came two speeches from arguably the two most powerful central bankers in the world. And their stories were very, very different. Federal Reserve Chair Janet Yellen's highly anticipated speech described an improving U.S. jobs market, albeit one that is improving slowly, and an economy that is making progress. But her European counterpart, Mario Draghi, described the euro area economy as one that is sick and made clear that the U.S. and Europe are on very different economic paths. But those weren't the only headlines out of the symposium. Something happened there in Jackson Hole today that has never happened before. Protests. Steve Leisman has more.
Under the shadow of the cloud-shrouded Grand Tetons, both Fed Chair Janet Yellen and ECB President Mario Draghi addressed the annual meeting of central bankers in Jackson Hole. And their speeches spoke of growing differences in their interest rate policies and economies. In fact, Draghi noted in his speech the, quote, diverging paths of U.S. and European monetary policies. Draghi, without reservation, said the euro area economy was uniformly weak and that unemployment was way too high. Draghi made a strong appeal for European governments to increase their spending and noted the European Central Bank was about to launch two programs to stimulate the economy. Yellen said the labor market in the U.S. is improving and gave an even-handed summary of the debate over just how much labor slack there is. Yellen said that if progress in the U.S. accelerated, the Fed could move up the timetable for removing stimulus. Neither Draghi nor Yellen made any new policy pronouncements, and extensive interviews with Federal Reserve Bank presidents show the real debate inside the Federal Reserve is between raising rates in the spring or the summer of 2015.
I'm holding to the mid-2015 view as the time in which I think the conditions will probably come together to make it a sensible move. But as I just said, and as Chair Yellen said this morning, if we see very, very strong data and they exceed expectations, then I think it could possibly be moved forward. But as of now, I'm a mid-2015er.
But Jim Bullard, the St. Louis Fed president, thinks an earlier move is warranted.
I don't think a little more hawkish slant has to be bad news for the economy. It means that the committee could be more confident that the economy is going to improve in the future and going to be able to handle the higher rates that will eventually come.
A new appearance at the meeting this year was a small group of around 10 protesters. They urged the Fed to keep rates low and focus on unemployment.
The Federal Reserve has its hands on the levers of macroeconomic policy, and we need the Fed to know that raising interest rates right now would send millions of people out of work, and it would be a terrible way to try to combat asset bubbles.
The conference, focusing on labor, is looking in-depth at the effects of technology, demographics, Fed policy, and government regulation on wages and unemployment. And it may just influence policy in the months ahead. For Nightly Business Report in Jackson Hole, Wyoming, I'm Steve Leisman.
Robert McTeer is very familiar with debating interest rate issues inside the Fed. For many years, he was a voting member of the Fed's policy committee when he was president of the Federal Reserve Bank of Dallas. Mr. McTeer, so nice to have you back on the program.
Thank you.
Well, let's begin talking about, of course, interest rates. When and how much? When do you think that interest rates are going to start notching up if you were voting inside the Fed? And how high are they going to go ultimately?
I was a July person, and I think after today I'm probably a March person. I think Chairman Yellen tilted just a little bit away from her extreme dovish viewpoint. I don't expect, though, once they start up, them to go up very fast. They'll just barely start going up. They'll worry about the consequences in financial markets. And certainly you don't want to be very long-term bonds when that starts happening.
You know, Mr. McTeer, you raise a very interesting question. I mean, the Fed, in pulling, restricting its bond buying, it's gone at sort of a $10 billion a month pace. I would expect when they start to raise interest rates, you tell me, that they'll move up at a quarter-point intervals. But one of the key questions here, it seems to me, is what is the new normal for where the Fed funds rate will end when the Fed ends raising it? Some people think it's 4%. Some people it's a little lower. What do you think?
I don't know, 2 or 3 points beyond the inflation rate, I suppose, would be the ultimate destination. But a lot has changed, and we don't know what all has changed. One of the most important debates that's going on there is the extent to which the labor force dropouts, the reduction in the labor force participation rate, is a cyclical phenomenon or a secular demographic phenomenon. If it's secular and long-term and based on just an aging population, the Fed would make a mistake trying to bring that back too vigorously. That's the important thing. Mm-hmm. But in addition to the dropouts from the labor force, something that did not come up significantly in the chairman's statement today is the very poor record of productivity gains of the last 3 years. We've hardly had any gains in productivity. So what you've got is fewer people working, and those that are working aren't producing much more next year than this year. So it's a very, it augurs ill for the potential output of the U.S. economy, and that's what they're trying to do. They're trying to reach potential without going beyond it.
I'd like to just switch gears a little bit here and talk about this disconnect between what's going on in Europe's economy and what's going on here, and these two very different presentations at the meeting today in Jackson Hole between Mario Draghi and Janet Yellen. To what extent do Europe's problems maybe change the timetable for raising interest rates or doing other economic moves here in the U.S.? Is there any impact at all?
Well, we are trading partners with them, and extreme weakness in Europe would have an effect on this economy. I wouldn't expect it to be extreme, but they appear to be going into a triple dip recession. I mean, they've already had sort of a double dip, and now they seem to be going back. The ECB is way behind the curve relative to the Fed. The Fed was aggressive very early on, and they dawdled around for a couple of years before they got very serious. They were even raising rates at, I think, in 2011. This was probably before Mr. Draghi replaced Mr. Trichet. Mm-hmm. But they're really playing catch up right now, I think, and need to be.
Mm-hmm. Okay, well, so really.
Also, I might add that the European governments were fighting recession with austerity. And we were not, primarily because we had gridlock in Congress, but we had a fairly expansive fiscal policy in the early stages of our recovery.
Mm-hmm. So maybe there's a thing or two they can learn from, the stuff we're doing here. Mr. McTeer, thank you so much for coming on the program. It's been a pleasure talking with you.
My pleasure.
Robert McTeer, former president of the Dallas Federal Reserve Bank.